Hi, let's dive into the fascinating world of credit scores and how they impact your mortgage interest rates. In this little chat, I will try to unravel the connection between the two concepts and how to show how much your credit score can affect how much you're going to pay on your new mortgage, on your new home, or your refinance mortgage. My name is Danholm, and I'm excited to be with you here today. I'm a real estate broker and a marketing specialist based in Central Florida, and I have helped buyers and sellers achieve their real estate goals all over the state. My expertise in marketing residential real estate has allowed me to assist countless of people achieving their real estate goals, whether they were selling or buying, and even if they were looking for a property that wasn't on the market yet. I'm really excited to share what I've learned over the years and my experiences with you. So let's get into this. Credit scores, those are these three magical numbers that plays a vital role in your life, and they help determine how much you pay for the privilege of borrowing money for a home or anything else for that matter. They're like a financial report card reflecting your creditworthiness based on your borrowing and your payment history, how you manage your debt. And lenders use this score to gauge the likelihood that you'll pay back your loan on time. That's what it's all about, making sure that you pay back your loan. So let's talk about interest rates. When you take out a mortgage, you're essentially borrowing money from a lender and they're charging you a fee for it. That's the interest rate. Usually that's expressed as a percentage of the loan amount you'll pay over time. So here's where the connection between credit scores and interest rates come into play. The higher your credit score, the more likely you are to receive a low interest rate on your mortgage. Why? Because the high credit score shows the lender that you're a reliable borrower, you're financially responsible, and they're willing to reward you with a lower rate because they feel confident that you'll pay back the loan on time. So, and a lower interest rate can actually save you a significant amount of money over the life of your mortgage. And I like to illustrate this with a little real life experience. We have two friends, let's call them Alice and Bob, and they both want to purchase their dream home. Alice has a pretty good credit score at 760, and Bob's credit score is just 620. So Alice at 760, Bob is 620. So Alice's higher credit score indicates that she's been responsible with her credit, she's paying her bills on time, and she's managing her debt wisely. So when she applies for a mortgage, lenders are very eager to work with her, and they will offer her, let's say, in this market, an interest rate of 6.5%. Bob's credit score, on the other hand, is somewhat lower, and that suggests that he might have had some issues paying his bills on time. Maybe he's got a high amount of debt. Maybe he's just being a little bit sloppy with his credit, or maybe it could even be, if it's not his fault, it doesn't matter to the lender. He is a high risk person, so when he applies for a mortgage, lenders are a little more cautious and they want to offer him an interest rate of 8%. There's a difference of 1.5%. It doesn't sound like a lot, but let me show you why this is a lot. So they both want to buy a house and take out a 30-year mortgage for $250,000. Alice's 6.5 interest rate would give her a monthly payment of roughly $1,580. So that's $1,580 every month, while Bob's 8% interest rate would give him a higher monthly payment of $1,835. $1,834 if we're to be correct. So over the course of 30 years, Alice would pay a total of $568,860 and change, while Bob would pay a whopping $660,386 and change. That's a difference of more than $91,000. So as you can see, a higher credit score can significantly impact the rest of the interest rate on your mortgage, and it also means that you're saving a substantial amount of money in the long run. It can also mean the difference between being able to buy your dream home or not, because in our example, it's very likely that Bob might not even be able to, if he makes the same amount of money as Alice does, he might not even be able to buy the same house as she does, because his monthly payment will be higher. So the lender would say, well, you need to borrow less in order to be able to have a chance to pay your monthly payments. So paying your bills on time, reducing your debt, and checking your credit report for errors are all great ways to boost your credit and in boosting your chance of getting into your dream home at a much lower interest rate. I hope this has helped you clarify the relationship between credit scores and mortgage interest rates. If you have any more questions or need more examples, please do not hesitate to ask. You can comment below. I just want to wish you a happy house hunting, and thank you very much for watching this video. If you enjoyed it and found it helpful, please take a moment to give it a thumbs up and share it with your friends. And I'd love to hear from you. Drop me a comment below, let me know what you think, or if you have any questions or suggestions for future videos, let me know that as well. If you'd like to talk to me personally, you can call me at 407-288-0704. I'll be more than happy to chat with you. Alternatively, feel free to shoot me an email at bent@maximrealtors.com, and I'll make sure I get back to you as soon as possible. And don't forget to subscribe to my channel and hit that notification bell so you never miss an update from me. I'm really looking forward to hearing from you and helping you achieve your real estate goals. Thanks again for watching, and I'll see you in the next video.